Okay, so this is where we left off in the prior, the first session of class. So we were talking about the most common type of acquisition where it's a non-taxable stock acquisition, meaning I'm buying somebody else's shares for cash and nothing happens to the inside basis of the assets for tax purposes. Okay? And two of you asked at break about, do I really set up a $420 deferred liability? And the answer is yes. And so I think it just might make sense to spend a second explaining why. Okay? So let's take this fact pattern and talk about why we need the deferred liability, why that makes sense. Okay? So in this transaction, we calculated and said the book basis of PP&E and the book basis of intangibles both exceed the tax basis. And therefore, we have a deferred tax liability for each. Okay? And so the entry that we're going to book, make this go away. The entry that we're going to book for setting up the deferred liability is basically debit Goodwill, 420, credit DTL. Okay, so that is going to be the entry that you, the tax person, tell the accounting guys to make. Okay, and as an accounting person can understand, you're sticking liabilities on the balance sheet through Goodwill. Okay, and normally having a liability on the balance sheet is a good thing because that covers a problem for the future. Okay, and if you don't have a liability and you need one in the future, you normally need to expense something to get a liability on the books. So people don't like expensing things. So setting up a liability on the balance sheet through Goodwill, that's like the nicest thing you can do, right? Because as a practical matter, most readers of a financial statements aren't focusing on Goodwill so much. So for you to be able to get liabilities on the balance sheet by adjusting Goodwill, that's kind of like a free pass, right? And this is a very practical statement, but yeah, Grant.
The only bad thing is I have to do impairment testing. I'm not quite.
I know, you guys, you and Timmy both raised your hand and she talked. That was good.
That's the way her husband is.
You guys are bucking for participation points after that exam, huh? Grant, yeah.
Oh, now I'm all flustered.
Listen to talk,
With
right?
Goodwill, though, aren't you able to amortize that?
For book purposes, the current rules under 810 or whatever the rules are, it used to be FAS 142. The rules are you don't amortize Goodwill, you just subject it to impairment testing.
Whatever it might be, but at that point in time,
Yeah.
you never impair it.
Normally, if you impair it, things are so bad that no one cares about
Yeah.
the tax consequences or any of that. It's just,
You
man.
probably don't even have to have
Yeah. So, again, we set up a deferred liability through Goodwill. Now, what would happen if we sold our PP&E and our intangibles for book value? Okay, so if we come along and Andy says, I want to buy that PP&E, I want to buy those intangibles, and we say, fine, you give us $1,200, you give us cash for $1,200, and we will give you our PP&E for $200 and our intangibles for $1,000. We will book that entry. Okay? But there is no book gain or loss when Andy buys our stuff for $1,200 because we have it booked for $1,200. Right? The accounting guys already recorded the stuff at fair value. And so there's no further gain for accounting purposes. But I have a big tax gain, right? On that proceeds of $1,200, I only have $150 of tax basis, so I have $1,050 gain, which means I have a tax of $420. So that means I have to credit my tax payable for 420. And if I want my balance sheet to balance, I have to debit something. So if I was smart in purchase accounting and I recorded a DTL, that's what the DTL is there for, right? It's there to anticipate that tax. If I didn't have a DTL, for whatever reason, then presumably that would be provision, right? I don't want to accrue a $420 provision expense when there's no corresponding book income. That's kind of a disaster, right? So I'm avoiding booking that provision expense by setting up a DTL in purchase accounting, right? So I like that whole DTL concept. Oops. Because when I have that DTL set up, that future tax event, it's basically already covered. This is just converting a deferred liability to a current liability, right? And if I don't set up those deferred liabilities, I'm in trouble in the future. That is going to be a problem. Okay? So does that make a little more sense in terms of why we're doing what we're doing? It's hard to see because this seems like funny, abstract, fake kind of accounting as opposed to something real, right? But accounting is going to amortize that 1,000 of intangibles. And if we didn't have that DTL there would be a rate effect. It would look like a permanently non-deductible expense. But now it looks like the reversal of a temp item. So the Goodwill just stays there. So now we have $720 in Goodwill, right? And the Goodwill just sits there. And every financial reporting period, the company is supposed to justify that it still has $720 worth of Goodwill. So it does what people would call impairment testing. And very rarely do you see Goodwill impairments, but you see them from time to time. And back in like '08 when the financial crisis hit, every company had Goodwill impairments because the value of companies' equity went into the toilet. So if the value of your company is low, that means the value of your Goodwill must be low. But these days, companies' values are pretty high. So you don't see many Goodwill impairments. You only see them when a company's equity value declines significantly. Like oftentimes, like AMD's stock has been crashing lately, right? Or Zynga is a perfect example. So Zynga went out and bought that company, Draw Something, right? Paid a bunch of money. They did purchase accounting just like this. Their 300 in this example was some huge number. And then Zynga stock is like $2 now, right? And so they're looking at that transaction and they're saying, it must not be worth what we thought it was worth because our whole company has significantly declined. So with last quarter, they impaired their Goodwill and they wrote off like half of their purchase price. And they basically said, bad on us, right? The Goodwill we booked, it's not really there anymore. And they hired some valuation firm, I'm sure, and that firm did a whole impairment analysis, and they came up with whatever the Goodwill write-off is. So if you want an example of one, that's a very recent example. But what the time to see it is when a company's stock has crashed, because that means their value is low, which means the value of their assets must be low. So that's a simple, litmus test for when to have impairments. For tax purposes, there's no concept of an impairment. This is a book concept only. Okay, so for books in our 720 of Goodwill, you're supposed to constantly prove you have at least 720 of Goodwill. If you think you have 820 of Goodwill, you leave the 720 alone. You don't book it up. It only goes one direction. Okay?
So from the valuation perspective of just the Goodwill, it would just use the basis of like somebody would not value, an investor would not value a company less than book value. And for that, from that perspective, or
what the accounting guys basically do is they look at your business and they divide it up into what's called reporting units. And so a company like a Zynga might have, multiple reporting units. They might say like the US is one unit, Europe is another unit, or online gambling is one unit, Farmville and that kind of game is a different unit. Like they divide up their business and then they hire a firm to go in and say, based on what our company as a whole is worth, how would you allocate it to the groups? And then they look at each group's goodwill and they say, well, we'll compare what that reporting unit's goodwill is to what its fair value is. I gave a whole hour on this topic at one of the high-tech institutes a few years ago. I can send you my slides if you want to see them, but it's a little hard to pick up just from looking at slides. Okay. So again, I want you to appreciate, well, why do we do what we do? And the reason is because if you think ahead, if you think to the future, you need this stuff. Otherwise, you have problems. Right? Okay, so now we're going to go into a bunch of specifics. Okay? And hopefully you appreciate so far in this class that I'm just trying to introduce you to the topics. Right? I completely get that 24 hours from now you're not going to remember it, and if I gave you a quiz it would be a problem. But hopefully you just hear it, you think that's interesting or not interesting, or how would I apply that, or do I want to know more? Now I can go back and read that book again that I sent you and it might make some more sense. I mean, that is kind of the goal of the class. Okay, so goodwill, in-process R&D, contingent consideration, these things can all be tricky. And earlier we touched on goodwill, and I showed you in the example that books called out goodwill, tax had no basis, yet we didn't do anything with it, right? So we're going to talk about that next. Okay, for book purposes, goodwill is just excess purchase price. Whatever you paid less whatever you bought in terms of identifiable assets, whatever the excess is, that's goodwill. Okay? So goodwill is not in and of itself an asset, it is just the excess. For tax purposes, goodwill may or may not be amortizable, it just depends. Right? So back to our confusing lingo, if I buy the stock of a company and it has no inside basis in its assets, then I don't get any tax basis in goodwill. However, if I buy the assets of a company and I pay that $1,500 in that example and the identifiable assets are only worth $1,200, I do get tax basis in goodwill and I can amortize it over 15 years. Right? So whether or not for tax purposes I can amortize goodwill depends upon the structure of the deal. Okay? Most deals I can't amortize goodwill because I'm only buying stock, I'm not buying assets. Okay? Okay. So goodwill will have what people call component 1 and component 2. Okay, so if you want to walk out of this class sounding like you know what you're talking about, even if you don't, this is a good way to say I'm pretty good with purchase accounting. I'm all about component 1 and component 2. Okay. Okay. So, component 1 goodwill is the lesser of the book goodwill or the tax basis in goodwill. Okay? So, if this is a stock purchase where there is no tax basis in goodwill, the lesser of book goodwill, which is some number, 300 in our example, or tax basis, which would be 0, component 1 would be 0. Right? The lesser of 300 and 0 would be 0. So in that example, I have no component 1 goodwill. Everything would be component 2, which is the excess. So if I have more book goodwill than I have tax goodwill, that's component 2. Okay? So let's imagine a situation where my book goodwill is, say, 300. And let's say that my tax goodwill basis is 100. Okay? And you might be thinking, how did you get 100? Well, let's say this company I bought, it bought the assets of another company before I bought it. Right? That happens all the time, right? I buy a company, they had bought a company before, that company had bought another company, right? Stuff happens. So let's just say that historically, for whatever reason, they had 100 of tax basis, and I inherited it when I bought this company. Okay? So on day one, I have book basis of 300 and tax basis of 100. Okay? So now, my component 1 is 100. It's the lesser of 100 or 300. And my component 2 is 200. Okay? And here, in the future, my component 1, I have a future temporary difference. So if I have 100 of goodwill for book and tax purposes, am I amortizing my book goodwill? No. Am I amortizing my tax goodwill? Yes. So as I amortize my tax goodwill, my tax basis will go from 100 to 0. And as I do that, I will save tax. I'll debit my payable, and I will credit a DTL. Right? My difference in deduction of that goodwill for book and tax, it's like any other temp difference, prospectively. I start with the same basis, but over time I create a basis difference. Okay? So I don't have a DTA or DTL on day one. I have the same basis, but over time I create a basis difference because of my tax amortization. For my component 2, here I have book basis, and I have no tax basis. And remember I said there's a special rule that says no DTL. Okay? And so what happens is in the future, if this company impairs its goodwill, if it says, oh, that goodwill's gone, then this is a future perm. Because that'll be a book expense. That'll be non-deductible, and I have no DTLs for it. So a lot of times when you see book impairments, like if you go and look up, I should have had you review the Zynga 10K, that would have been better one, or their Q. When you look at the Zynga 10Q, I guarantee you they'll have a huge book impairment charge, and the tax provision will show a giant perm item, because that deal was structured in a way that they won't have tax basis and goodwill. So they will have a book expense, and there'll be no DTL to deal with the fact that that book expense is non-deductible. So they will have a giant perm. Again, I don't think anyone's focusing on, like, can you believe Zynga's tax provision? This is crazy. They have a huge perm, right? Most people are focusing on the fact their stock is $2 and they just wrote off half of a purchase price of a company. So the fact that the tax accounting is a disaster is like the 5th biggest problem I have, right? But the tax accounting is a disaster, right? They have a big book expense that's a non-deductible perm because we have no DTL. And that's just the mechanics of purchase accounting. Okay. So component 1, component 2, the accounting is very different, right? For component 1, it's book equals tax to start with, and then you have a basis difference over time. For component 2, you have a difference without a temp item, without a DTA or DTL. And that is true when book is greater than tax. But when tax is greater than book, it actually works the opposite way. You do book a DTA. That rarely happens. So I don't really want to focus on this side of the picture, but it goes both ways. 10 times out of 10 or 9.9 times out of 10, you'll end up on this side of the spectrum. And you will have a situation where you have a component 1 that creates a future DTL, and you have this hanging perm out there that's just waiting to cause a problem for you. Okay? That's what happens most times. Okay. So now when you want to look smart about purchase accounting, you can say component 1 and component 2, but you can't look at the way you're looking right now. You have to act more confident. You have to play poker a little bit. Okay. Okay, so we'll do an example. So We buy a target for 1,500 bucks. The example was the same as before in terms of how we allocate purchase price. We're assuming that this is a non-taxable acquisition, meaning we don't get a step up in basis for tax purposes. But here you'll notice that we've changed our tax basis assumptions. It's not the same as before. Okay? So our facts here are a little different. So if I was going to do purchase accounting in this situation, right, I don't have differences here or here. I only have a difference here of 200. So here, my component 1 is the lesser of book or tax. And the lesser of book or tax is, my book is 300. My tax is 100. So my component 1 will be the 100. And my component 2 will be the 200. Okay? For my component 1, this is really just repeating what I just said. Book equals tax, but there's a future temp item. My component 2, I start with no DTL, and there's a future perm waiting to happen. Okay? The reason that they don't have you book a DTL on day 1 is they say, well, Goodwill is just the excess purchase price. And so if you booked a DTL on Goodwill, that would mean you'd have to credit DTL. And what would you debit?
Goodwill.
Goodwill. So then you'd have to say, okay, I guess I have even more excess purchase price. But if you debited Goodwill, then now you need another DTL because it's become circular, right? So I think they looked at that and said, this is stupid. We shouldn't do this, right? We should just stop after the DTL on identifiable intangibles and just leave Goodwill as the excess without doing a whole tax gross up. That's just not helpful to the reader. Okay, that's the theory. Okay, so now we're going to do an example where it's a taxable asset transaction. Okay, so this is where I'm buying the assets of a company. I buy the assets for $1,000 in cash and assume a liability with a face of 700. But the assumption is that the book guys only value the note at 600. Okay? And this happens, right? Sometimes the book guys do things differently than the tax folks. So that means the book guys are going to say that, well, the fair value of your assets is only 1,600, while the tax guys are going to say, no, the purchase price was 1,700. We paid 1,000. We assumed a liability of 700. We paid 1,700 bucks. So as a result, our tax basis in Goodwill is greater than books. So in this example, my component 1, the lesser of book or tax, my book is 400, my tax is 5. The lesser is 400. And here I have an excess tax basis. And I actually do book that as a DTA. Okay? So this whole idea of not grossing up purchase price for DTLs, it doesn't work when you have DTAs. Because when I book that DTA, I'm basically going to say debit DTA, credit Goodwill, right?
So in effect, Goodwill gets back down to what it wants it's going to be.
Absolutely, and as you can see here, this becomes circular as well when you do the math. So it becomes confusing. This is an unusual fact pattern. So if your brain is running out of space in terms of things to remember, don't remember this. Okay?
Mine falls out. It just, okay.
I have a question. So what if you acquire a company with a division loss?
What if you acquire a company with what?
With a division loss?
With a built-in loss. Okay?
Like, how does that affect on taxes?
We'll get to that in just a second. fact, I might just jump to that. The topic I just skipped, contingent consideration. So in my world, this is interesting. I sense from this group this might be too much. So if we have time at the end, I can come back to it if you want to hear more. But my guess is you'll cry uncle by the time we get to the end.
Uncle?
Okay. All right, step 3. So this is kind of segueing into your question, which is, okay, I buy a target. I want to know what target's tax attributes are. Okay. So uncertain tax positions. So when I buy a target, and again, remember, we're focusing in this class mostly on I buy the stock of a company, which means when I buy the stock, I buy their historic asset and liability type attributes, and one of which could be this company's never filed a tax return in state X. And that could be a problem for me as a buyer, right? So I need to know that. So I think maybe Patty or Susie, one of you guys was talking about diligence, right? Buyer will get a diligence team. They'll go ask a lot of questions. They'll find out what the potential problems are. And if there are potential problems, I might just accrue those in the opening balance sheet, right? And that could be as simple as an entry where you record a credit to a FIN 48 liability, a tax liability, an exposure of some amount, and you'll just debit Goodwill. And your finance guys are going to say, hey, if you think there's a problem and you think there's an exposure, let's get the liability on the balance sheet through Goodwill, right? This seems like an opportune time to put any liabilities on the balance sheet that aren't already there. So you oftentimes see companies without exposures on their balance sheet suddenly have exposures on their balance sheet, right? And there was a reference in the Lamb 10K about this, and I don't know if you caught it, but the reference basically said that, hey, we just bought this company, and one of the things we're still trying to figure out is what liability to put on our balance sheet for their tax exposures, because they told you that they're not done figuring it out. But implicit in that is we didn't like what they had, so we're going to come up with our own number. And what they're thinking, and this is not technical thinking, but they're thinking practically, it would sure be nice to kind of get the right liability on the balance sheet now, because we get a chance to book that through Goodwill. But the obvious tension is Novellus was a publicly traded company before they were acquired, and they were audited. And so it's a little hard to have the same facts on one day and not have a liability, and have the same facts the next day and have a liability. So this last paragraph here in the slide is about you have the same facts, you should get the same answer. But as a practical matter, buyers often take another look at the exposures and they try to get the right liability on the opening balance sheet, right? And by opening balance sheet, I mean what the buyer records for buying the target. Okay? And if you put yourself in buyer shoes, of course you're going to want to do that. You're going to want to say, well, I might not feel so great about what they had on their balance sheet. I want to put what I think is prudent on the balance sheet. And so that's very common. Okay. I don't know that Timmy, I answer your question like in a really straight up sort of way. So let me just do it kind of freehand here. Okay, so Timmy's question was, I go buy Target for $1,000. Okay, and let's say that Target has it has IP that's worth 600 and Goodwill of 400. Okay, and let's say that the tax basis is 0 in both of those things. Okay, and the amount of the company's NOLs that they have are, say, 100. Okay, so these are my facts. Okay, so what do I do? Uncle Sam, what do? I buy this company. I have a built-in loss. Okay, so what do I do with that built-in loss?
You don't get it because it's declared.
Okay, hold on. Let Uncle Sam take this one.
Well, it depends on what kind of structure you have. You know, if there's a 382 application, you don't get the NOL.
Okay, so we bought the stock of this company and we paid $1,000 for it. So the way 382 works is that $100 of NOL will be limited, right? But I paid enough for this company, I'm going to get this NOL. It might just take me a couple years. Okay? So I know enough about 382. I'm telling you, 382 is not going to be a big problem. Okay? It's going to be a really small problem. Okay? Okay, so we get this NOL and we're going to use it. So what do you think I ought to do with that NOL in my opening balance sheet? Okay, that doesn't answer my question. What am I going to do on my opening balance sheet? All right. I'm going to book a DTA, right? Okay. What else am I going to do? I'm going to book a DTA of, say, $40. What else am I going to do?
Goodwill.
Well, do I have any other deferreds? Shoe King? You guys are thinking, I didn't know I was going to be called on. That class got easy all of a sudden. Goodwill. So my book basis in Goodwill is 400. My tax basis is 0. Do I book any effects for that? Right. Lady Min's going to help you out. She's saying that that's going to create a DTL equal to 40% of 600, right? Or 240. So you are going to book both an asset and a liability. So the journal entry that you're going to book is a debit DTA. You may not book it gross like this. So you will book an entry that looks like that, right? You are booking on the opening balance sheet the assets you got, like an NOL, and the liabilities you inherited, just like in our prior example, which was the DTL for intangibles. Okay, so you book both. If you said, oh, 382 is going to be a huge problem, I'm never going to use these NOLs, then you wouldn't book this, right? And you would book that. But an NOL is just another tax attribute that we're going to book as a buyer and say, look, we got something here, right? We have an asset. It's just like any other asset. Okay, so that hopefully answers the basic question of if I buy a target with an NOL, what do I do? Okay, I book its attribute. Okay, now, a woman called me from a company, maybe a month ago, 6 weeks ago, and she had a question about an acquisition and how they accounted for it. And her question had nothing to do with this next topic, but as I was talking to her, I raised this issue because she did what we're about to talk about totally wrong. And I'm pretty sure like that night was just a bad night for her, because it's not good to find out you did something wrong. And this area is a tricky area, okay? So valuation allowances. So if I'm a buyer, okay, if I'm a buyer and I have a full valuation allowance, okay, I've been losing money, I have NOLs, I have a valuation allowance, my blood pressure is low, right, I'm just relaxing, and I buy a company and it brings with it deferred tax liabilities, okay, I'm going to say, well, look, I've got plenty of assets to net with your deferred liabilities. So in order to net, I'm going to release some of my valuation allowance, right? So let's say that buyer has 100 of DTAs with 100 of VAs, therefore 0, and target has 30 of DTLs. Okay? So what buyer is going to say is, oh, hey, look, I have a plan. I'm going to release some of this so that this is only 70, and that will allow me to book 30 of assets. And that way we'll just net my assets with your liabilities, and we'll still be back to zero, which is kind of where we want to be. Okay? Well, so in this situation, the buyer is going to say, I'm going to debit DTA, or I'm going to debit my VA, depending on how you look at it. I'm going to recognize some of my assets to net with your liabilities. And as a result, in order for buyer to balance their balance sheet, they got to credit something. And that credit is provision. Okay? So it's recorded as an income tax expense item, which is wild, right? So like you could look at one of the companies I do a bunch of work for is, well, EA had this when they bought PopCap. If you guys ever play that like zombies game, that Plants vs. Zombies game, my kids love that game. When EA bought them, EA looked like buyer. They had the NOLs and a valuation allowance. And PopCap looked like target. They had a big DTL. And EA said, hey, I'll recognize some of my assets right now, and that way we'll net our stuff. So they booked an entry, EA did, where they debited their deferred assets, and they credited the provision. And this was like, I don't remember the number exactly, but I want to say this was $40 to $50 million. And they're like, look at us, we just bought a company, and we saved $50 million on our tax provision. So, wild accounting, right? LSI just did the same thing about 9 months ago with the deal. And I remember their VP of tax was like, this cannot be right. And I'm like, I will give you the full, like, Sokol guarantee. That's how it works. But it's very unnatural, right? And this is kind of a new rule. This rule came in with FAS 141R, which was back around 07, 08. When I grew up, like when I was at your experience level in the firm, it was different than this. So this is a relatively recent thing. And that company I said, well, the woman called me about some other question about her deal. She was buyer with a full VA, and she acquired Target with a DTL, and she didn't book this provision benefit. And hers was like 20 million bucks. Yeah. I'm like, have a good night. So that's an interesting, you know, if you haven't worked on a business combination before and you're doing the provision and you're that buyer where it's kind of sleepy, right, because you have a full valuation allowance and there's not much going on, this can really surprise you, right? But once you see it once, you won't forget it because it's so unusual.
Yeah, well, I was thinking it'd be a good surprise.
You know, anytime something is as weird as this, it tends not to really count. People look at it and be like, I need to really know what the normal provision is because this is not helpful for me to understand your company, is usually how it is. No one's looking at EA going, hey, things are really picking up because they had this weird one-time benefit.
Well, they didn't have to pay tax. That too.
This is funny accounting. This is not real tax. Okay, so target. Okay, so we just talked about what happens if you're a buyer and you release your valuation allowance. Okay?
Is it when you buy them actually, or is it an anticipation of buying?
It's when you buy them.
Buy all of yours done.
Right, when you buy them. Amanda.
What are your rules on lease-based valuation? I don't just arbitrarily, I don't need it.
Well, if you remember, okay, so your question is, can you just arbitrarily net DTLs and DTAs, right? So one of the questions on the exam was, you know, what are the 4 sources of income to recognize a DTA? One of them is a reversing taxable temporary difference. That's this IP stuff. It's a taxable temporary difference that will reverse when books amortizes the IP. So it is the essence of what you would use to support DTA recognition. Okay. But it is very funny, abstract, non-cash accounting, right? This is theoretical stuff here. Nothing on your tax return is going to help you understand how to get this right. This is accounting theory. Okay, so by contrast, if you're dealing with Target's valuation allowance, If you're setting up or you're releasing target's valuation allowance, all that goes through goodwill. Okay? So it's the complete opposite. If you say like, hey target, you don't need that valuation allowance, you're coming with us now, we make money. You might have been losing money, had a valuation allowance, but you can release that now. That release does not go to the P&L. That just shows up as another DTA we bought. Okay? By contrast, if you say, hey target, you have all these DTAs, those things are no good, we lose money around here, right? We don't book DTAs, that's not what we do. To write off those DTAs, that goes through goodwill. Okay? So on the target side, you just book through goodwill whatever you think the right answer is from target's perspective. So it's very different, right? And if you tried to sit with somebody and say why, it's good luck. It's hard accounting logic. But the theory is you're looking at what did you buy, and that's a target question, and all that target stuff will go through that purchase accounting. Whereas your stuff, what happens to you, that has nothing to do with what you bought. That's just an indirect effect on how it impacted you, and that's somehow a P&L accounting event. Okay? But these things often tend to be huge numbers. I mean, you rarely see this being small. So if you make a mistake, you usually make a huge mistake. So it's really important when you're doing a deal to do the accounting very carefully, because if you suddenly got these two mixed up and you put put the target through the P&L and the buyer through goodwill, that would be a disaster. So you have to be really careful to catch these things. Okay, so I think we covered these things. Okay. Is that enough on goodwill? I blew through like 10 slides there, but they kind of repeat what we already covered. And I feel like we've had enough of goodwill. You guys want to talk about goodwill at all? I should really change the format of the course and test this stuff.
If you don't have goodwill, you keep making these adjustments through, then it's going to be the P&L?
If you don't have goodwill, what do you mean? Like you didn't pay enough to have an excess purchase price?
Yeah.
You have negative goodwill.
I mean, you're talking about, oh, it goes to goodwill, it goes to goodwill. Well, what if you don't have goodwill?
So let me just kind of freeform an example. Okay, so let's say that we pay $1,000 for a company. And let's say that it has IP worth let me change the facts a little bit. Let's say we pay $900 for a company and it has IP worth $1,500 with no tax basis, and therefore our DTL is $1,500 times 40%, or $600. So our net assets that we got are $900. Okay. So from a book perspective, our guys are going to debit IP for $1,500, credit DTL for $600, and credit equity for $900. Right? So if the valuation firm said, well, let's think of an example. So let's say we buy this company. There's no goodwill, right? This is just what we paid. And let's say that we paid, we had an earn-out too. We said, look, we'll pay you $900 for your company, but if it does really well, we'll give you another $100 later. Okay, so that happens from time to time, right? Buyer and seller can't agree on a price. They'll say, well, we'll true it up later based on how you do. Okay, so there's an earn-out of 100, and so that extra 100. Okay, so we credit equity another 100, and now the question is, what do we debit? Okay, what do you think you debit? Timmy, what do you like to speculate on these things? What do you think you debit? Come on, now's the time for a smart answer.
I debit IT.
That's the wrong answer.
No.
Smart answer.
I have no idea.
What do you say?
I have no idea.
Foreign currency adjustment.
Now you're talking.
Foreign currency adjustment.
Oh, sounds good. He seems smart. Rochelle, what do you think you would book? What would you debit? It depends. Yes, that was my clue. You said I don't know. That's not. It depends.
I said that first. But
Okay. It depends. That's the smart answer. That was my clue. It's a smart answer, right? It depends. Okay, Janie, what does it depend on?
It depends.
I'll stick with Timmy then.
Okay, who knows what it depends on?
What's the probability of you collecting $100?
We already paid the $100. $100 is real. Rohan, what do you think? Min, come on, what do you think it depends on? You're a smart guy. A lot of things. Come on, somebody knows. The book basis? I don't know, kind of, maybe. An, what do you think? You've seen this. It depends. No. It depends on what the value of the IP is, right? Because here, it was worth $1,500 because, in effect, that's what we paid for it, right? We paid $900 plus we assumed a DTL of $1,600, so therefore this was the implied fair value.
I said that though, and you said no. I said IP.
Dude, we might have to rewind the game tapes on that one.
Didn't I say IP?
You said IP.
I said IP.
Okay, so, well, but the answer is it depends.
so he answered when he said no. He was saying no to Timmy's answer.
I think I was saying no to his answer. Try to back him up. All right. So if the valuation firm says, you know what, that IP is only worth $1,500, then the answer is Goodwill, right? We can't book more than $1,500 of IP. They said it's worth $1,500 of IP. That's the most we can book. If the valuation firm said, no, you know what, that IP was probably worth $2,000, and the fact you only paid $900 for this company, good for you. You know, you kind of get a deal. We think that thing was even worth more. So in that example, that extra 100, you're going to book to IP. In which case, you're going to follow it by another DTL entry, right? In which case, there'll be more to IP, and it'll be circular, right? But it'll depend based on what the valuation firm comes back in terms of the value of the assets. Okay? You see that oftentimes when companies buy really small companies that aren't even like full operating businesses, but you know, just a small group of people have a great idea, and the value of the purchase price goes all to IP, and there really isn't, it's not possible to have a business without customers and products and that sort of thing. This is a common fact pattern. In fact, these used to be called EITF 9811 transactions, 98-11, and that guidance dealt with transactions where it was an acquisition of assets that didn't qualify as a business. And you would see this accounting very frequently. Okay. You're like, that's too much information. Okay, transaction costs. Okay, when one company is buying another, bankers, lawyers, accountants, a lot of people get paid, right? These things are expensive. And they're expensive because it's complicated, there's a lot of risk, you can't be wrong. And I know it sounds nice to be working on these deals and it's all fun and all that, but there's a lot on the line. And there's a lot of costs that go with it. So you got to figure out how to deal with these costs. Yes, Timmy? Obama won the election, huh? All right. That will not help you in the rest of this class. Okay.
I was going to answer that way on the phone.
Transaction costs. Okay. So, transaction costs. For financial reporting purposes, psst, you guys are like 6-year-olds. Financial reporting. Transaction costs, if you're the buyer, costs get expensed. Okay? This is a relatively new rule. This came into being at the same time that valuation allowance rule came into being. Okay? So now, if a company, if Zynga is going out and buying this other company, Draw Something, or if Lamb's going out and buying Novellus, and it's paying lawyers and accountants and bankers, all those costs get expensed on the P&L. Okay? For tax purposes, those costs might be deductible, they might not be deductible. Okay? It depends. And it's complicated. There are people like within the big firms that make a career out of just answering that question. Okay? It's like R&D credits, right? People just do R&D credits. There are people that just do that question. So know that books expenses, tax sometimes deductible and sometimes not. And so you need to kind of understand that to know how to deal with the tax accounting, right? Okay.
What about stock? Because they always, not only they pay their lawyers, their accountants, and the investment bankers, but they also give stock to the investment bankers.
Let's go with the it's simpler than that, and they're just paying them cash.
Okay.
Okay, so let's assume that I'm Lamb, and I'm thinking about buying Novellus, but I haven't bought them yet, but yet I'm spending money on bankers, lawyers, and accountants, right? Because these things have a long lead-up time, right? In fact, I remember when I was driving home from Thanksgiving, man, that was the day, the Sunday I was driving home, that was the deal was on, because I was on the Novellus side of the transaction. And these things just all of a sudden get rolling, but nobody knew at that point, right? It's kind of secret, they're working on it, they haven't told anybody, but yet they're incurring costs, right? So in that period, before they've told anybody about the deal, they're expensing costs that are hitting the financial statements, and you, the tax person, you may not even know about this deal. Like that deal was kept pretty quiet and surprised a lot of people. So you, as the provision person, you may not even know some expenses in your P&L relate to this transaction that might be non-deductible, because you may not even know there is a transaction. But if you're doing the provision for the quarter, you're going to need to know if there's a big perm item, right? If there's a big non-deductible cost, you kind of need to know about it. But this is like a chicken or the egg thing. You have to know about the deal to know if there's a non-deductible cost. And if you're not in the know on a deal because it's meant to be quiet, you're going to have a hard time knowing that. Well, one of the views that the current accounting guidance allows is it says, look, if you don't have a deal that's closed, meaning it's a real deal, that it's happened, you now own this company, you just assume that there is no deal. Okay? And so this is an accounting policy that you can elect that basically says, I don't need to know if there's a deal or not, because I'm just assuming there isn't one until there is one. And the vast majority of companies that I see, they apply this policy. And they treat any cost that hit the P&L as if they're deductible, just like any other cost.
What is the deciding factor if there is a deal? Because what if a deal falls apart?
Then there's no deal. There's a deal when the deal happened, as in past tense.
We are now one.
Right. After Lamb bought Novellus, there's no unbuying them, right? They bought them. But if they just announce them and say, hey, we have an agreement, we're going to buy them, but we have to do 8 things and get clearance from these regulators, and the shareholders have to vote, then you didn't buy them yet. You just agreed to buy them. But agreeing to buy is not buying. Right?
Doesn't the SEC take a long time too, before they, or, I forget.
So the agreement in the Lamb Novellus transaction happened in December. The close of the transaction happened in June. So stuff happens between. And during that period, they might have said, there's like 100% chance we're going to buy this company. And all along, the accounting policy would be, there's no deal. There's no deal until there's a deal. Okay? Well, so you're confusing the tax rules with the accounting rules. Okay? So for purposes of determining whether a cost is deductible or not, you will look to the letter of intent, you will apply the Section 263 rules, you will do a whole tax analysis of those costs. But for purposes of the book rules, you may elect this policy that says, I don't care what tax law says, until there's a deal, for book purposes, there is no deal. And if there's no deal, these costs would be deductible. So this is where the book theory overrides what your tax person logic would have you normally think. Okay? So I've been working on a transaction. In fact, you can ask Don about this next week. Don's been living this pain for a long time because they've had a number of things in the works that you'll see in their Q3 financials. And we've had this conversation with their financial management team on, people will say, hey, there's a lot of costs being incurred. Do we need to do something with this? And we keep saying, hey, there's no deal until there's a deal. And people are nervous about that because it feels very artificial, but that's our accounting policy, and that's very consistent with what a lot of companies do. What that, of course, means is at closing, right, if Lamb was saying, oh, these costs are always deductible, and I don't know their policy, I wasn't them, I was on the target side, but if they were saying, hey, these costs are deductible, their costs are deductible, and then all of a sudden we close the deal and they're like, oh, a bunch of these costs are non-deductible, right? They take a perm charge, they take a hit in that quarter. But usually in that quarter, there's a lot going on, right? And so it's very easy for them to say, hey, don't worry about it, this is like a one-time thing, it relates to this acquisition, we can explain it. And they can explain that the tax accounting for the deal happened in the same quarter as the deal. Whereas it would have been a lot harder for them 6 months ago when they were just thinking about the deal to tell the reader, hey, we have these huge perm items because we're thinking about doing an acquisition we've told you nothing about. Right? That's kind of a quagmire that they can't really get into. Okay, so the most common view is people treat these things as deductible, and if there's a non-deductible ETR hit, a perm hit, they usually book that at the closing of the deal. Okay? And I'm like 100% positive that's what happened with the Lamb and Novellus deals, but I think it's probably small enough where you can't find that in the public info is my guess. But that would be the most common view. The other view would be, well, every quarter, I call up my business development guys and say, what are you working on? Tell me your deals. Tell me the expenses you're incurring. I need to know if these are deductible. And if you are able to gather that info, more power to you, but that is hard. Right? If they wanted you to know about the deals, you would have already known about the deals. Okay, so I think I'm going to stop and save the file here. So we're just going to take a short break.